Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 19th of July. I'm Daniel Lam, your host for the podcast. To be or not to be, that's the question. Last Friday, I had such a Hamlet moment. I needed to run an errand for my son after work, and I decided not to take my laptop back home for the weekend. Well, from the news at that time, the typhoon that was approaching Hong Kong was unlikely to escalate and disrupt work. But it actually did at the end, and I was stuck at home without my computer on Monday. Now on Tuesday, the Hong Kong markets reopened after the typhoon, and as we discussed at the podcast earlier this week, it did take the signal of the quote-unquote reverse hammer pattern on last Friday, i.e. selling off from the highs and closing near the day low, which is usually a signal for pullback. And it ended up the same way on Tuesday, with even higher volume in fact, so there could be further pullback in Hong Kong China equities in the short term. Now the key trigger was the lower than expected GDP figure in China on Monday. The second quarter China GDP grew at 6.3% year on year, which was below market expectations at 7.1% growth. Now, if you remove the base effect distortion and take the 2-year compounded annual growth rate, i.e. the CAGR, it slowed to 3.3% year on year in the second quarter, from 4.7% in the first quarter. So yes, the economy is weakening, but it does not appear to be weakening at a rapid pace. Now, foreign investor positioning in China has been declining, and this latest round of data misses could push toward a final quote-unquote sell-out of equity positioning. Now, each instance of data misses had been met with calls for fresh stimulus. And valuation of MSCI China is actually, once again, back to more than -1 standard deviation compared to its 15-year average valuation discount versus the MSCI All Country World Index. So, facing all these, would the Chinese authorities have a Hamlet moment and go for large-scale stimulus? Well, the new China policies appear to be focused upon long-term and quality growth. But even targeted stimulus, which is our base case expectation, that's likely to be enough to lead to some rebound in Chinese equities, such as what we saw from the extension of some of the property supporting policies last week. The Politburo meeting at the end of this month may include a combination of further loosening in housing policies, especially in Tier 1 cities, fiscal stimulus, and strive to encourage consumption. So overall, Chinese equities have the appearance of a high convexity trade, i.e. limited downside, with reasonable upside potential. Hang Seng Index may be supported around the 18,300 to 18,900 area. And consumer discretionary and communication services are our two top sectors in Chinese equities. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.